What stock do I think is going to do better over the next 5 years? Palantir or Tesla? Well, my automatic thought says Palantir. But I think here's the deal, okay? Tesla. What needs to happen for Tesla to have a great next 5 years? Elon has to remove himself from all of this political related stuff. He's got to stop pissing people off. Like, I don't know the way to put it. He's got to stop pissing people off, okay? If he could manage to just lay low, get back to, people used to look at Elon as a genius, as, one of the most intelligent people in the world, like a hope to humanity. And he eroded so much of that last few years. If he could just chill and get away from all the political crap, posting all the political crap, and stop making people mad, right? Especially his core customers, the Europeans, the liberals, like the ones that actually buy Teslas, the Chinese. If he can do that, right? I think Tesla can set up very well for the next 5 years. But he's got to do that. Because at the end of the day, his making people so mad all the time is actually making people say, Tesla's not cool anymore. I don't want to buy a Tesla. I'd rather buy anything but a Tesla, right? I was just behind a car. Oh, I got something I'll show you guys. This was just a week or two ago. I was behind a Tesla, right? And look at the sticker on the car right there. That's what I'm talking about. Even people that drive Teslas are ashamed to be associated with it because of Elon and the stuff he says and does and those sorts of things. So at the end of the day, he's just got to avoid all that crap, man. Because, the old saying was go woke, go broke, right? The same exact thing works on the other side. You want to go so far to the right and you got a big left customer base, you go broke, right? And that's exactly what we see in Tesla. I mean, Tesla stock was $400+ years ago. And we're still a long way from $400 today, all these years later. I remember Tesla stock back in 2021 being $400+ or around there, right? And here we are today, all these years later, 2025 now, and the stock is 270 or 250 or whatever it is, right? And so if he could do that, I think then Tesla can start to recover. We'll start to see sales bounce back because at the end of the day, they put out a great product and the price has gotten very compelling now. Tesla a few years ago was the expensive vehicle. You were more of a baller if you owned a Tesla, right? It's not like that nowadays. Nowadays, if you look at used Teslas, used Model 3s and used Model Ys and whatnot, it's now a mass market vehicle. Even on the new market, even if you get them to lease, Tesla could get to a place where they could be making 10 million cars a year. Elon's just got to get out of all the political related crap. If he can do that, then we're talking, baby. We can be so back. But if he wants to keep being way right, posting stuff that makes people all mad, it's not going to happen. It's not going to happen. Now, robo-taxi opportunity, also a big opportunity for the company, obviously, right? They do have significant competition there. I think Waymo's the biggest competitive threat in that market, right? But it's going to be a massive market, so there's going to be several players that can be big in that market. You could have Tesla being a big player. You could have Waymo. I think Amazon's going to have a good chance to be a big player in that market as well. So we'll see several different companies compete there. There'll be one or two that end up being the biggest, and I'm not sure if Waymo's going to win it or if Tesla's going to win it. Waymo's out in front right now. We can say that confidently. There's countless markets you can go in today and take Waymos. You go to Arizona, you can take Waymos all around the east side. You go to San Francisco, you can take Waymos all around. I took, when I was in San Francisco just about 3-4 months ago, we took Waymo rides everywhere, and experience was pretty good, not perfect, but pretty dang good. And so Waymo's out there in front. Now Palantir, listen, Palantir is the easier choice. And you know why Palantir is the easier choice? I'll show you exactly why Palantir is the easier choice to outperform Tesla the next 5 years. Here's why. Look at this. This is Palantir's revenue growth. Now, recently it's taken off to whole other levels, right? But the moral of the story is Palantir is a company you can count on year in and year out growing. The only debate with Palantir is, are they growing over the next 5 years? Are they growing at an average of 20% per year revenue? 30%, 40%, 50%. You could debate that, but there's no debate about Palantir growing significantly. Whereas you look at somebody like a Tesla, look at this. This is, their business was growing great, and now they've been in stagnation for quite a while and expected to be in stagnation still in regards to revenues, where it's, minuscule. Now, hopefully the brain can get back on point, and then 2026 we could talk about, nice revenue growth again into 2027. But at the end of the day, we'll see. The other great thing with Palantir is Palantir doesn't have to deal with making very large physical items that are very, very costly to make, right? They don't have to deal with all the logistics of that. Palantir's just got a naturally better business model than somebody like a Tesla, right? And so, and even if you think about the robo-taxi opportunity for Tesla, which is a massive opportunity over the next 10, 20 years for them, right? If they can capture a certain percentage of that market, even that's a very difficult business. People make it sound like, oh, it's so easy. No, that's going to be a very difficult business. Who's going to clean all the cars, right? And operate all those fleets? It's going to be Tesla personally. They're going to have a bunch of people outsourced there. If you outsource it, you're going to definitely cut down on margins, right? What about all the maintenance of the vehicles? If it's Tesla's own fleet, now you got to deal with all the maintenance of that. That's a nightmare to deal with. That's very, very costly. It's extremely heavy on CapEx. So, this is all the legality. What happens when one of these robo-taxis hits somebody, that somebody's, doesn't make it? You're going to, it's a lot. It's a lot of crap. Tesla's just got a way harder mountain to climb. And it's an additional harder mountain to climb when your CEO makes people mad all the time, right? So the moral of the story is here, Palantir's just got it easier. Now, Palantir also trades at a pretty rich forward P ratio, certainly, right? So that's really the only, when you look at Palantir, that's honestly really seems like the only risk in regards to Palantir is the valuation is very high, right? Extremely high price to sales ratio, extremely high trailing 12-month P, forward P, everything across the board, right? And you say, well, yeah, it's got great growth, all those sorts of things, but shoot, man, it trades at very, very rich multiples. I mean, very rich multiples. If we pull up Palantir here on 1000xstocks.com, forward P's in the 200s. Usually you're looking to pay somewhere around 18, maybe 20 for an average stock out there, right? It's in the 200s. So that's a very, very high number. Trailing 12-month price to sales ratio for Palantir's in the 70s. In the 70s, folks. That's a very, very high number. Now, if we want to compare Palantir versus like an AMD, 200 plus forward P for Palantir versus AMD's at like a 27, right? So, versus NVIDIA's at like a 22, right? So that's the only bad thing you could really say about Palantir is, that forward P is very high. That price to sales ratio is very high. By the way, if you want to follow me on X, I always have that linked in the description area, all my videos. You're more than welcome to follow me on there if you're somebody that uses X and you want to follow me and keep up with my posts and things like that on there. But, man, we'll see. We'll see. But the moral of the story is I think Palantir's got an easier case to outperform Tesla over the next 5 years. Tesla has a chance, but, man, Tesla's just got a lot harder mountain to climb to get there. A lot harder mountain to climb.
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are three main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management. And you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there.
All right, let's get into big tech next, and then we're going to get into this last one, which is around financial crisis and recession.
Technology stocks are coming off, of course, that rally yesterday, historic rally. This morning, Andy Jassy affirming that the AI spending at that company is going to continue even as tariffs raise potential supply chain concerns and expenses. Deirdre Bosa has more on today's Tech Check.
Very important, I say this right off the bat in regards to this. This is phenomenal news for companies like NVIDIA, companies like AMD. I mean, because this is one of those time periods and there's so much uncertainty. People are like, what if the big tech companies cancel all their chip orders, right? With NVIDIA and AMD and these sorts of companies. A lot of people worried about this. This is very impactful for positive.
Hey, good morning, David. So remember his comments too. They follow Senator Pichai yesterday, also reaffirming Google's CapEx this year. Bigger picture is that amid the tariff volatility of the last week or so, the message on AI has been consistent. This is optional. This is not optional. It's existential. We've heard from tech leaders, from Google Senator Pichai to Shopify's Tobias Lütke, now Andy Jassy in that Amazon annual shareholder letter, reiterating that this is a once-in-a-lifetime opportunity that must be seized aggressively through deep investment and full-stack integration, making AI more than ever an easy and obvious contender for Amazon's fourth pillar. That is, businesses that signal where Amazon sees durable growth and where it's willing to bet big for the long haul. Yet Jassy stopped short of naming it in his latest annual address to Wall Street. Amazon's first three pillars, they are Marketplace, Prime, AWS, massive defensible businesses that drive consumer growth and customer loyalty. Now, leadership has been searching for a fourth pillar for at least nearly a decade. Back in 2017, when I first attended an Amazon AGM, Jeff Bezos declared that they were hard at work finding the fourth. Then again, during his last shareholder meeting as CEO in 2021, Bezos said they were still looking and there were a lot of contenders, but that the bar was extremely high. And it's not that Jassy isn't contemplating it. In his letter last year, Andy Jassy called out Gen AI as the next primitives or foundational tools core to Amazon as a whole. Since then, Amazon has gone deeper into the AI stack, more workloads on its custom AI chips, continued infrastructure build out, its own foundational models, and the app layer soon as it gets ready to roll out an AI revamped Alexa voice assistant. Now, in owning the full stack, Amazon's strategy, it's starting to resemble Google's, which is seen as further ahead in the race. So as tariff whiplash continues and it hits Amazon's largest marketplace pillar particularly hard, investors, they could expect Jassy to double down on AI, calling it out as its fourth pillar. Guys, that would be a strong signal and maybe a missed opportunity in this latest letter. Of course, we cover Amazon so closely. We know that they have these pillars. I'm not sure how widely that is known, but it would certainly send a signal to longtime investors that it is all in.
Yeah, and advertising, which has become such an important component, that's just lumped in a marketplace, I guess, right, Deirdre?
No, I mean, some have considered and that that advertising could be that fourth pillar. It's just grown so much. Prime Video could be another one. And, when Bezos was asked about this during his last AGM, he raised video as a possibility, some others, but it just feels like since 2021, AI is the thing that runs through all of the businesses that is powering advertising more than ever. The other pillars that it seems like an easy one where Amazon could get out ahead because, in tech circles, it is still seen as sort of playing catch up to some of the other mega caps and AI first companies in the space.
Okay, Deirdre, thank you very much.
Yeah, Amazon, steal deal here, every single correction crash, Amazon's always a steal deal, and this is just another one.
To start here, Josh, where we are now, because the damage that the president and the administration have caused to all of this doesn't just reverse in a day. And I think you're starting to see some of that. We still have tariffs, big ones on China. They're going to hurt growth. And that's why recession possibilities are still as elevated as they are. What do you see?
I think this is like the aftermath of yet another bear market bounce. And these things are mentally debilitating for investors precisely because of how quickly they slip away. Yesterday is the 10th best day of all time for the...
They're only very hurtful and demoralizing to investors if you're getting caught up in all the emotions of like, oh, we hit the bottom, oh, the market's up, so we hit the bottom, and all that crap. As long as you're taking the standpoint of, hey, I want to get as many great deals on stocks for as much as possible in 2025 because I'm going to be buying this whole year. Like you're not getting caught up in all that, right? It's only the people that are hoping for a bottom right now.
P500. I heard that breathlessly reported everywhere. I saw the tables, all the graphs, all the charts. What didn't necessarily accompany that commentary was the context in which we've seen the other 9 best days of all time. And I'll spoil it for you. Typically, they take place in years like 1933 and 2008 and 1931. And they happen when the market is in a 75% drawdown. A 48% in October 13th of 2008 was the 6th best day ever. We had a huge 11.6% run. We were already down 35.9% from the high. Yesterday is peculiar in that it didn't take place in a statistical bear market, down 20% or worse. It's a little bit shallower than that. But from my perspective, close enough. Horseshoes and hand grenades. The median stock was in its own bear market. Most sectors that matter with market cap were in their own bear market. So what happened yesterday, while it was exhilarating and remarkable and a lot of fun and a lot of backslapping and a lot of rich kids who are really proud of themselves because they grew up insulated from the consequences of their own actions, the end result today is, oh, wait a minute, maybe we put the financial crisis on hold, but we still get to have a recession. So that's how I feel. And I don't want to get too negative, and I'm not out shorting the market, I'm not a hedge fund, but I just want to give people a really accurate picture that this feels more to me like a classic bear market than it does a correction or a dip or a quote-unquote healthy pullback.
Yeah. So, Steph, the VIX, which was at 50 yesterday and then got a lot of air taken out of that balloon, is on the rise again by a lot. It's at 42.5. It underscores, where we are. I thought Sarah's point was important, too, at the end of the prior hour. It's the dollar's worst day since 2022. The typical safe havens have not been such. Dollar bonds, munis, for example, which a lot of our viewers, I'm sure, are invested in. I'm wondering what you do in an environment, as I said, the damage that was caused here, the self-inflicted damage that was caused on these markets doesn't reverse in a day.
It definitely does not. There's still a lot of skeptics out there. I didn't see anyone really reverse course that was negative, that went to positive. Numbers are coming down. Estimates are being reduced. They have been for a while. Target prices are getting cut. This kind of after the fact, Scott, to be honest with you. Look, it's not often. And in fact, in 33 years of doing this, I've never been up 9.5% in a day. We know the long-term total return in general for each year is 7.7%. So yesterday was great. I'm not in the recession camp. No, I'm just not. Not with the weekly jobless claims where they are, and you're at 220,000 on a 3-6 month basis. Recession is 350 to 375. Inflation is coming down, not to the 2% we needed to, but it's coming down.
CPI report was really good.
So
and on any other day, at any...
So here's the issue about the whole recession thing. Listen, everybody's so obsessed with trying to call a recession all the time. Recession. And we just see it year after year after year after year. And it becomes much more pronounced when the stock market's in a correction or crash. And that's when people really start to question, recession's coming, we're in recession, whatever. And it's hilarious. Like, people are so obsessed with, the recession call. And it's like, we'll see. Let it play out, man. Everybody was convinced we were going to have some sort of major recession. 2023 never came. Like, come on.
I know.
We'd be like, this is exactly what we've been waiting for.
But maybe, just maybe, we start to make good progress on inflation, and then maybe you get the Fed conversation back. I don't know. I don't think we're going to see 100 basis points of cuts, but maybe if we keep getting inflation down, that is a good sign. So I am just not in the camp of recession. I'm in the camp of slowdown. I'm in the camp of, are we flat? Are we up 1%? Okay. Now I want to hear what companies have to say in terms of earnings. Numbers, again, have been reduced dramatically. The stocks are down dramatically. I want to see how they respond tomorrow, starting tomorrow.
You can't expect.
If they cut, how do the stocks react? That'll be very telling to me.
I know, but you can't expect, can you? I should ask you rather than make a declarative statement. Can you really expect that these companies who have absolutely no visibility whatsoever are going to give any kind of guidance on any level that sounds good? If they even are able to give guidance at all.
No, but I got stocks down that are 25, 30% into that.
I know, but if you're having a recession, they may not be down enough.
But I'm not in that camp. I'm not in that camp. I just told you why. I'm just not. But I have stocks that are down a lot into the print. So the expectations are very, very low. And what is very clear is that Trump and Bessent are watching the bond market. You lose the bond market, you're going to lose everything. And that's why they actually reversed course yesterday, in my mind.
Oh, it's clear that, the bond market's, ruling the day. We learned the lesson of how powerful the bond market actually is yesterday. Some comments from Jamie Dimon talking about recession apparently swayed the president as well. But again, I just look where we are at the screen. You can't normalize in any way what's taking place. Yesterday's rebound wasn't normal, and this activity today, down as sharply as you are, as I said, you got a lot of problems to deal with that were self-inflicted. Business has no confidence in their ability to see anything, okay? The fog may have dissipated just a little bit yesterday, but it's still nasty out. Consumers, you think they're looking at their investment accounts, their 401ks, 529s, pension funds, and feeling great about going out and spending money now?
Yeah. So, we all know we're a consumption economy. That's 2/3 of GDP. And so consumer sentiment, you can say it flips on a dime, which it can, but it definitely, especially with the unrest, can become a self-fulfilling prophecy on top of CEO sentiment. And it's just hard to believe that we're on the precipice of earnings seasons. And I think every company is going to come out like Delta and say, I don't know guidance. How can you say that with a straight face as a CEO? And I think the banks will be really interesting because they're at the epicenter, because they have how much are they going to spend, M&A, et cetera. And so I think we're going to continue to be in this, I still think, this 2018 environment on steroids. And if you go back to 2018, you had 8 drawdowns between 8 and 15%. Half of those drawdowns were between 10 and 15%. And I think what other, nugget you have to sprinkle into this is that.
So before she goes further, I just thought of this is going to be a huge earnings season for a very specific reason. Okay, listen, and it has nothing to do with, listen. This is a very important season to see who are really the best of the best companies out there. Because the best, safest business models are going to be able to give guidance. Are going to be able to say, we think we're going to probably do this number to this number. You know what type of companies are probably going to do that? A lot of companies that have recurring revenue streams, recurring revenue business models, right? They're going to be able to give a guidance and feel comfortable giving that guidance. You'll find out the weaker businesses and the weaker business models because they won't give any guidance. Or if they do give guidance, it's going to be a massive range. But a lot just won't give guidance. That's a sign of definitely a weaker business. It doesn't mean you can't own those businesses or you can't own those stocks. It's just understand they're weaker. But if a company can give a good guidance and feel comfortable giving that guidance in this market, in this environment, which is the most uncertain we've seen certainly since 2020, that's a pretty dang impressive sign. That's a very impressive sign. That means like that company has a very special business model. Very special.
It's not going to come in. There's no Fed put here, unless, let's say, something breaks, but there's no Fed put because they're not going to be contra to a strategy or tactics they're not aware of.
No, but if, people were speculating yesterday who just watch markets well, like Mohammed El-Arian, for example, who joined me on Closing Bell, that in his mind, the Fed wasn't that far away from having to do something. Whatever the something is, that's not a bullish environment.
Stabilizing the Treasury market is historically not bullish. Yeah. I would also point out that 45 basis point swing in the 10-year is maniacal. Like, this is not... Again, I want to say, it's a pullback. Just pick your favorite names and load up. I think you should be a buyer if you have a really long-term time horizon. You should not expect that the buys you make today will necessarily be rewarded a week from now. It's just a different 100%. Environment. A 45 basis point swing in 3 days is the most that we've seen since 2022, which is another legit bear market. We've only seen that 7 other times going back to the year 2000. And on every single instance, the S&P was down 25% or worse. That we've seen that. So again, that is a classic feature of when the S&P is down big. You get those huge swings in the 10-year. Now, I want to take it a step further and say, okay, great, we have the carnage.
Yes.
I just don't know if it's gone on long enough to really register.
You've got the market down 15% from highs, 18% for the NASDAQ. You've got stocks that are down 30, 40, 50% from
Agreed.
their highs.
Agreed.
So I would say, yeah, there's things to be concerned about, but you've got to look at opportunities for the long term.
But
right?
here's the problem. Then so you buy a stock 35% in the hole, come out with earnings not as bad as feared. Maybe they even give guidance. 43% of companies in the S&P 500 give sequential guidance, so that would be great. And then the stock rallies by 10%. You say, I made a great buy. And then a week later, it's rolling back over lower lows. This is the main concern right now, I think, amongst Wall Street strategists. It's not, are these stocks compelling values? It's, is there a trapdoor in what looks like it should be the low?
So, yeah, I think it's very important I say this, right? I need to echo what Josh Brown said there in terms of, if you're buying a stock today, don't expect to make money on it over the next week or the next month or the next quarter, to be quite frank. You never know what can happen here. Now, how do you continue to get a stock market to continue to crash significantly from here? Not just like volatility, like up a day, down a day, and it just kind of stays in this range. How do we get a NASDAQ to go to 14,000 from here instead of, 16,000 where it's at, right? How do you get a stock like Adobe to go from 340 to 240 or to 280 or something like that? Now what you need is another huge bad thing to come out. The first thing that really got this market to go down was tariffs, right? Second thing that got to go down was, oh my gosh, the tariffs are way worse, way more extreme than anybody anticipated. Boom, next leg lower. So how do you get the next leg lower? Now you need something really bad to come out. Inflation spike huge. It doesn't look super realistic, but if that happened, that would freak the market out. Probably not happening though. A recession, like more recession signals. So like a really bad jobs numbers or some really important big companies to announce they're doing major layoffs because of the tariffs or something like that. Stuff like that could maybe give the market like a next panic of like next leg lower. China unloading treasuries, right? And let's say the 10-year spikes up huge again. My gosh, that would freak a lot of people out in a significant way. If all of a sudden you saw that 10 years starting to move up toward 5%, whew. And then you have some very important individuals at the Fed come out and say, they're still not in any mood to cut rates. Like, you need more significant, scary stuff to happen to get the market to crash further and further from here. You can't just have the same, because we all know about tariffs now. So you're not going to go down on tariffs anymore. We already know about that. That's done. Now you need something else big. Does China go into Taiwan, right? Okay. Then that's the next big leg lower. You need more big events to continue to get the market to freak out. And so that's an important thing to understand. If you don't get that, then the market will start moving up. That's just what happens. If you stop having a next new big event that freaks everybody out and says, oh gosh, I know I'm already down huge on the stock, but I got to go sell. If you stop having those, then the market starts to drift higher, and the market starts to come back. And everybody's like, whoa, geez, the market just went up 10% in the past 3 months. Like, oh, that's interesting. Like, and it sneaks up, kind of underneath everybody. So important to say that.